Prithviraj Srinivas is here with us. Prithviraj, good afternoon. Thank you very much for your time. You just heard my colleague talk about how broader market stocks are starting to perform as well. Just taking a leaf out of that analysis, I want to understand from you, as someone who looks at economics and the high frequency indicators very closely as well, how are you gauging the health of the broader economy, the mid and the smaller companies and enterprises across the country as an indicator of the state of the economy?
Right. So Ajay, I mean, one clear takeaway is that while sentiments are upbeat, market sentiments are reaching record highs. The high frequency indications on the ground show that growth momentum is still quite weak. Today we got the services PMI number. It shows that in October the activity is still in contraction, so it's below 50. Late last week we got the manufacturing PMI number, which also showed that momentum was fairly weak. So while we do expect Q2 numbers to show to sort of remain quite weak, even Q4, so October is entering Q3, so December quarter, there as well we are seeing that indications haven't improved. So it clearly tells you that investors are sort of looking beyond the current downturn. The downturn could continue for another quarter or so, but they are willing to look beyond the current downturn, and that's a positive sign. And to a large extent, we believe that the reason for investors looking beyond the current downturn is the corporate tax cut, which the government delivered.
Prithviraj, how are you
at this stage? I also want to highlight.
Yeah, go ahead.
Go ahead. I want to also highlight, our 33 cities yatra that we recently conducted to, understand the slowdown, where we, interviewed more than 150 businesses across the country. And one clear takeaway there was that, there is a structural element in the current downturn. That is something that we cannot ignore. While to a large extent, people will look at this slowdown and say it is cyclical, given that, credit-led consumption has sort of peaked, and you should see, some amount of slowdown, for a couple of quarters, largely because of these cyclical reasons. But there is a structural element as well, and some of the reasons for the structural element are by design. So we believe that, the entire supply chain in the country is going through a transformation, largely because of reforms such as GST, the anti-black money campaign, as well as adoption of technology like e-commerce. Now, because of that these three aspects, you're seeing that the supply chain is going through a transformation. So if we speak about logistics and supply costs in the country coming down from about 14% to 9% of GDP. Now that additional 5%, which will eventually come across as efficiency gains, is today somebody's income, and that income is getting displaced. And this group of middlemen in the country whose income is getting displaced are a large consuming class. And that's the reason you do see the weakness in auto numbers. So my sense is that, some of the high-ticket discretionary consumption slowdown has a structural element, and it will take some time for consumption in these items to sort of recover.
Prithviraj, how are you observing the inventories at dealers? Are they coming down? The inventory in the system, be it auto inventory, be it consumer discretionary inventory, even some of the large commodity companies, steel companies, the inventory in the system which had got piled up, because of which the utilization level across the country was very low. Do you think that has got adjusted in the last couple of months?
Yes, certainly. I mean, there is an improvement in inventory. I mean, we did expect this. So we did say that, look, inventory had moved up across the country. So now what you would see is a period of manufacturing slowdown. That's the reason, Q1 and Q2 of this year has been largely led by a contraction in manufacturing activity, where manufacturers have, slowed down their production or even cut back. And pushed retail sales through discounts, and because of this, you are seeing that retail level inventory is coming down. And the festive season has also sort of helped, and it's a seasonal bump up in sales, and therefore it has helped in bringing down the inventory levels. But the key question we have to ask today is what will be the base level of demand after inventory comes back to normalized levels. And there my answer is that given that there is a structural element in the slowdown, and given that monetary policy will take a little bit longer this time to work its way through the system, given that there is very high risk aversion in the banking and financial system, my sense is that the base level of demand will therefore be much lower than what people expected, and therefore capacity utilization will also to that extent be weaker. So my sense is that you will see at a retail level inventories normalize, but at a manufacturing level you will see an improvement from quarter one and quarter two, but it's not going to race ahead back to the earlier inventory levels, because the base level of demand, the trend rate of demand will be much more weaker than what we had in the last couple of years.
Prithviraj, which quarter do you see a bottoming out of Indian economy happen? The reason why I ask you is that to understand the market will clearly bottom out before the economy bottoms out.
Right. I think to that to some extent that has already taken place. I'll give you a sense of some of the numbers that we can expect. So quarter two GDP is most likely going to come at about 5.2% versus 5% last year. There is some amount of base that's going to help. But while I talk to you about YOY numbers, I think the key thing that most of us will look at is sequential momentum. Now, if you look at seasonally adjusted sequential momentum, last quarter, that's June quarter ended, it was about 1.2%, which is an annualized run rate just under 5%. And this quarter, our assessment is that based on the high frequency numbers that have come for the September quarter, the sequential run rate is more likely to be at about 0.8%. Q on Q seasonally adjusted. That's an annualized run rate of about 3 to 4%. So we do see that the September quarter is most likely looking to be the trough, and we do see that in the upcoming quarters we will see an improvement. So you will see on a sequential basis there will be an improvement, largely led by an improvement in manufacturing activity as well as higher government spending. But the question again I come back is, what will be the pace of recovery? So the exit is going to be much more weaker than what we expected. It's not going to be a V-shaped recovery. It's going to be more, it looks more likely to be a U-shaped recovery from here.
All right, Prithviraj, we'll let you go on that one. Thanks so much for joining us this afternoon and help us.
Of course, markets, as you can see, is sort of assuming a much more sharper recovery.
That's correct. Perhaps valuation argument is favoring the market. Well, we'll leave that for some other day. Thanks very much for chatting today with us. That was Prithviraj Srinivas of